Today we will take a look at two popular ETFs in Charles Schwab's SCHD SCHD versus Amplify's Divo. We're going to take a look at these ETFs to see which ETF is better in an investor's portfolio. Both of these get a lot of buzz because they offer high quality diversification and they also offer really high dividend yields. Let's first take a closer look at Divo, which was first established at the end of 2016. Their goal is to seek dividend and option income for their investors, and they may offer lower share price volatility versus the overall market when it declines. Divo is actively managed by Capital Wealth Planning. Generally, I don't like to see actively managed funds, as that involves human emotions, and humans, they just tend to make many emotional decisions, and that causes them to underperform the market. Passively managed ETFs typically follow an index, so they usually have a lower expense ratio than those that are actively managed like Divo. So Divo can charge a higher expense ratio, as we see Divo has an expense ratio of 55 basis points. That means for every $10,000 invested, you are paying $55 in fees for doing all the work for us. However, Divo does have a very impressive track record, so perhaps having to pay money to make money is totally worth it here. Divo only holds 27 different holdings, significantly less than other ETFs. Their holdings are all strategically selected to fit into Divo's objective and strategy of finding high-quality, large-cap companies that have a history of dividend growth, can offer a high total return, and are risk adjusted. We can see they're pretty top heavy as they have companies like Microsoft, Visa, United Health Group, McDonald's, Home Depot. These are all around that 5% mark, making up nearly 50% of the ETF right here alone. We can see they're pretty diversified across the sectors of consumer discretionary, energy, IT. They're all around 13% apiece, but healthcare with some really heavy exposure here at 21%. Unfortunately, I don't see any real estate exposure here. Looking at their entire portfolio, we can see these are all blue chip companies with big name recognition. The only one I doubt you recognize is called Schlumberger. This is actually a French company that, despite its name, they don't actually sell burgers in the slums. But they actually are a very large oil field services company that brought in $28 billion in revenue last year. So all these companies are legit, and one really cool thing about Divo is that they actually show all their options trading here at the bottom. So here we can see they have a call option on Merck. There's 5,000 different contracts on this particular call. For this Merck option, it looks like the strike price is 111, and the option will expire on March 24th of 2023. So we can see they have other covered call options here with UPS, Home Depot, Nucor, and our old French buddy Schlumberger, which again doesn't sell burgers in the slums. Divo's covered calls are tactical, meaning they will try to take advantage of current market conditions and manage risk opportunities for the short term when writing their covered calls on individual stocks. Divo does not write calls on an index like many other income ETFs. Of course, anytime covered calls are used, that might limit the potential upside of the ETF, and there's no further downside protection other than the options premium received. By practicing this strategy, Divo is hoping to pay about 2 to 3% of its dividends from the dividend income it receives from buying and holding stocks, and the other 2 to 4% will come from options premiums. Divo also keeps about 7% of its portfolio in cash. Let's just hope that's stored away in a Fidelity high-interest money market fund. Divo has an impressive track record of paying dividends since its inception. However, it doesn't seem like there's really been much dividend growth, going from just 12 cents a month in 2018 to its latest distribution, which is 14 cents 5 years later. I typically like to see my dividend companies and ETFs raise their dividends over time. Now let's compare to SCHD SCHD, which is not an income ETF, but an ETF that passively tracks the index of the Dow Jones US Dividend 100, and because it's passively managed, they have a much lower expense ratio of just 6 basis points. And that really does make a big difference because over decades of investing, big expense ratios can really eat into an investor's return. SCHD has 103 different holdings, with the average market cap of a company being $127 billion. This is also a very diversified fund with heavy exposure to tech, financials, and consumer staples, as well as all the other sectors except real estate. Nobody likes real estate for some reason. SCHD doesn't do any options trading. Its dividends are coming straight from the positions it owns, and that's why the dividend yield is lower at 3.5%, which is still absurdly high for how high quality this ETF is. Another benefit of not doing covered calls is that the portfolio's growth is not stunted in times of bull markets. SCHD dividends should be taxed as qualified dividends, which get preferential treatment, unlike Divos, which might be a hybrid of both qualified and ordinary income. SCHD has been around since 2011 and now has $47 billion in assets under management, way more than Divo's $2 billion. It has also grown considerably in the last 5 years, as it just continues to get a bunch of free advertising here on YouTube, but also because the fund has just performed so well. Since the start of 2017, SCHD has a CAGR of 12.5% versus the market's 11.62%, and Divo's 11.48%, which means SCHD has been beating the market and Divo has actually slightly lagged. However, I think the most impressive part about this is actually not necessarily beating the market, which is really hard to do, but notice the worst years, the market was down nearly 20%, but SCHD and Divo, they were down just 5% and 3%. Now that's going to be really good news for investors, especially those closer to retirement. You can get consistent income and not have to worry about the principal balance going down significantly in times of a crash, which is not a worry you want to have when you're older. Many ETFs say that they are low volatility, but this just proves they can back it up. SCHD and Divo have also outpaced the market in the past year, which was a really rough 2022. One thing I love about SCHD is that its dividends have actually grown over the years. It's given almost a double-digit pay raise each year since its birth. This is a big deal to me because I want to see my dividend income continue to outpace inflation when I'm in my retirement, and that's certainly something that Divo can work on. So people are going to ask me, which one is the better investment? Is it Divo or is it SCHD? Honestly, both are great tools one can use to build wealth. SCHD will probably be better for the younger investor who has plenty of time to experience capital appreciation and collect those large dividend payments every quarter at a really low expense ratio that won't dig into their total returns. But Divo is a really solid tool for those that are in the wealth preservation mode of life. Ones that have already accumulated all their money, they don't necessarily need to work hard to get more riches. And an investor in Divo, they're probably content with modest capital appreciation, and they love getting a 5% return in the form of monthly dividends. Now, I personally own a couple $1,000s worth of both Divo and SCHD between my taxable and retirement accounts. I know I get two high-quality funds working for me, making my financial independence goals a reality. And just remember this one quote, guys: nobody is in charge of your financial future other than you. Want to see my full $120,000 portfolio that I was able to reach in my mid-20s? Check out the Patreon link below. Support a small-time YouTuber, hit that like button, leave me a comment on if SCHD or Divo is the right ETF for you in the comments below. My videos are always found in podcast form under the Collect Cash podcast name. And say it with me, Benny Boy, buy, stash, and collect cash.